What's up, guys? I'm going to go over credit spreads, what they are, and how to put them on. So let's get started. Just to start, you're going to want to find a stock that has an IV rank. So you want to find a more volatile stock usually. Or their premiums are worth more for what they are. So Apple has an IV rank of 38. Tastyworks shows the IV rank. TOS shows the IV percentile. So you want a high IV environment for credit spreads specifically. Lots of liquidity in your stock. Usually over $1 million. You can go way more, but I usually try to keep it over $1 million for volume and over about 50-ish for the price of the stock. And so let's show you how to put it on. So when you get started, you got to figure out, all right, what expiration date am I going to do? And so usually you're going to want 30 to 60 days out for your expiration. So today we are in October 11th. So I usually just do the next monthly that is within 30 to 60 days. So the next monthly is November. So we go to November and we decide, all right, are we bearish, are we bullish, or are we neutral? So if you're bearish, you would do a call, a short, call, bearish credit spread. I know it's kind of long to say, but it's a bearish call credit spread. And then if you are bullish, you're going to want a bullish put credit spread. And so you decide which way you think it's going to go, or where you think it's not going to go, essentially. And then you go from there. So with Apple specifically, let's just say we'll go to its chart. Say we are neutral to bullish on Apple. It's got its keynote event for revealing the iPhone, the 5G iPhone 12 this upcoming week. Are kind of, the stocks have been kind of moving up lately. Just in general, the market's been moving up lately. So let's just say we are neutral to bullish on Apple or QQQ or SPYs, whatever we want to say. We're just using Apple as an example. So we're neutral to bullish on a stock. See how we have a really good resistance right here at this 112 area. I don't know how to get rid of that part. But we have a good resistance right around this good support right around this 112, 112.5 area. And so when you want to do your strikes, you want to collect a third of the width of the strikes. So say your strikes are $5 wide, a 110 and 105. A third of 5 is 150. So you got $5 wide strikes and 150 in your credit. This gives a probability of 50%, 81% probability of 50%, and almost always it gives a 68% chance of probability of profit at expiration, which we're not going to hold it at expiration. So you put your spread on. It's 40 days till expiration today. We're going to close this spread at 21 days till expiration. So it's 40. So that's about, I think that's right around the 30th of October for November. So we're going to want to close. So we put it on within 30 to 60 days. We collect 1/3 of the width of the strikes for whichever direction you want. If you were bearish on Apple, you would want to collect 1/3 of the width of the strikes, regardless of where you are. That's right around, it doesn't have to be exact, but right around 1/3 of the width of the strike, which that would be a 20-25 roughly, or like a 21, somewhere around here. 22.5, 20, right there, 65%, 76% probability of 50% profit. If you drop it down to the 125, 130, you're collecting 128 with a 69% probability of profit and a 78% probability of 50%. So those are that's two things to start. You want to, once more, a spread, you want 30 to 60 days out, and to collect a third of the width of strikes. Usually I do $5 wide strikes, just because for the most part that's the most liquid strikes. Notice how this says at 107.5 we have 9,000 open interest. 105 put, we have 18,000 open interest. The 110 put, we have 31,000 open interest. This will keep the bid-ask spread low and keep our fills damn near instant. So what is this saying essentially? Let's go back to, so we have the 110 and 105 strikes. Go back to our chart. That is, quote, saying, this is, you want your spreads to expire worthless. Your credit spreads. You want your credit spreads to expire worthless, which means you think that the stock, Apple in this case, is going to stay above. It's not going to get in the money, so it's going to stay above 110 to 105 until November, or in our case, 21 till the expiration, till the end of October. These are what we call optimal mechanics. They're mathematical rules based off of a high probability statistics that are going to make the most amount of profit with the least amount of capital in the long run. So these are why we use these rules. These are when I talk about optimal mechanics. These are rules. You don't break rules are sometimes meant to be broken, but 95% of the time you do not break your rules. This takes out the emotion in your trading and strictly gives you math and probability. Those are big old keys. So you have the 110, 105. You have a good support right here at 112. Just happen to be. And so 110, 105. You think it's going to stay above there. Apple's got its keynote. We had higher buyer volume on Friday, which means we may keep going up. So let's look at another example. We'll go to something that's less volatile and show you why we don't want to do those. Let's just go NEO. It's low, under $50. IV rank is 17. It's not very volatile for the IV rank. So let's say we have a 1/3 of the width of strikes right here. Notice how we just collected 1/3 of the width of strikes, just under. If I dropped it down $1 each, I would probably, nope. So yeah, just for 1/3 of the width of strikes, we would have to be $2 or just $1.50 out of the money. Notice how close to the money that is compared to Apple, which is more volatile, where we are, the stock price is at 117, we'll round it up. We're $7 out of the money for Apple, instead of being $2 out of the money with a lower cost and lower IV. We're only $1.50 out of the money instead of $7 out of the money for Apple. Yes, you could still do this. Its probability is less, as at 62 instead of 68. Probability of 50% is at 77 instead of 80. So you still have a decent probability, but in my opinion, it's not worth it. The risk to reward is too close to being in the money. If something goes wrong, you're way more likely to get for your spread become in the money. Go to Zoom or Tesla. We'll go to Tesla. Tesla's got a 29. That's okay. I try to keep them over 25 usually. So just like Zoom, or just like Apple, you collect a third of the width of strikes. Notice how I usually already have a lot of these more liquid stocks on. $185, $180, $385, $380. Exactly 1/3 of the width of strikes. 64% probability of profit. It's probably a little more. Tesla is so volatile though. IV at 80%, so its expected moves are very, very high. That's why the probability of profit isn't quite as much. But if you go to the Tesla chart, so 385, 380, we'll look at that. We have some good resistance right here at 400 level. 385, 380 is right underneath it, under this gap right here. Right here, this little volume imbalance. I hate this part. That's a volume imbalance. So our strikes are below this. 385 right here and 380 right here. That's where our strikes are. And so you're more likely not to get hit in these strikes. We'll go to... And so this is the mechanics of how to do it. I honestly I don't know if I put that on, if I said that yet. So when you are selling, so right now we are selling a put credit spread, a bullish put credit spread. I'm trying to slow it down because I can speak fast sometimes. We'll go back to where we were, to the 385, 380. So you are selling one strike that is out the money, and then you're buying another strike that is even further out of the money, usually between 2.5 to 5. As you get more advanced, you can get spread out a little more. But to start out, especially for beginners, I just say 2.5 to 5. I'll show you why right here. This is math. So collecting a third of the width of strike for a $10 spread would be about $3. So we'll say this one right around here we'll just do 265, 275 because it's easy. It's just over $3. Not too bad. Probability profit is 68%, but your max loss is $650, as opposed to if you were to drop it to your 150, your $5 spreads, your max loss is $350. I would rather, personally, if I'm going to get to max loss, if something goes wrong with my trade, I would rather only risk $350 than $600. Even if I'm making a little more, the probability and also just right now as beginners, you're losing more in one trade. I would rather have multiple trades on, and that way if I lose on one trade, it's only $350. That's max loss. At 21 days, your average loss is about $100, we'll say. It's actually like 77 to be very close to exact, but we'll round it up. Your max loss on average for cutting it at 21 days is about $100. So you're not going to get, for a $5 wide spread. So you're not losing nearly as much if it goes the opposite way you think. If it goes not against what you're saying. So if you have a put credit spread and it goes down and it keeps going down, you're saying, what's going on with Tesla? If you still cut it at 21 days, you're most likely, it's not going to be max loss, and you're only going to lose roughly $100. This makes our risk management very low, our risk to reward a lot higher, because if our average loss at 21 days is only $100, and if roughly about 50%-ish at 21 days, you're making at a 150, you're making $75. So our risk to reward is pretty decent. It's almost a 1-to-1. And with credit spreads, you're going to risk more than your reward is, but the probability of profit and the probability of you making at least 50% of that credit makes up for that extra risk that you put on. So that's it. It's a give and take. You give a little risk to take a little probability that's in your favor. This gives us a mechanical edge to create consistent profits. And so that is credit spreads in a quick note. You buy your high IV, you want credit spreads in a high IV environment. About if you're doing deltas, if you don't have Tastyworks, you can Robinhood or TOS, you can look at your deltas, and so your delta is going to be let's see, for a 385, your delta is 27. So your delta would be 0.27 on like a Robinhood or TOS, Thinkorswim. I'm gonna look it up on Robinhood right now on my phone. So a call spread, they're not gonna be exact. Yeah, it's a delta. So your exact delta on the 385 in Robinhood right now is a 0.27, which is 0.2750. So they're the same. They're marked different. This uses the actual numbers instead of having the contract numbers. So if you look on Robinhood, it'll say 0.27 instead of just a 27. It's 0.27 instead of 27 delta. 27 delta is the probability of it being in the money at expiration. So when we sell, when we are doing a spread, your 27 delta is really a 71%. Actually, it's more than that math-wise, but this gives it a 71% probability of profit. If you look on Robinhood, at 385, says 71%. Perfect. And so these are your deltas. Also it not only gives the amount that your contract moves per dollar, it gives the probability of your contract being in the money at expiration. So if you're looking on, so when I say 20 delta, that's a 0.2 delta. That's an 80% probability of profit. So we'll find the 20 delta over here on Tesla. See my delta's moving down. Right around 360, 364. So let's say we did a spread at 360, 364. Right around a 20 delta. 80% probability of profit, 50%, 71% probability of in the money at expiration. That's just because of the low open interest and volume. But this is what we're really paying attention to. 76% probability of profit, 85% probability of being in the money at expiration. They get the on Tastyworks, they use a probability of profit also based off of the bid and ask spread, which that's a little more advanced. I usually focus on the deltas more than what they say with the probability of profit. A 20 delta is an 80% probability of profit. 22 delta is a 78% probability of profit. 25 delta, 75% probability of profit. Notice how it just goes up to 100. 25, 75 plus 25, 100. I round everything up. These 0.4, whatever, that doesn't really matter too much. when we're selling options, when we're selling credit spreads, because you're just not, you're not going down to the key. You're not doing, you don't care if it's 64.1% probability, 64.2% probability. A 65% probability is a 65% probability. So these are the optimal mechanics of what we are doing with our credit spreads. These are how I'm going to do it every single time. Almost every time. So there's a couple little tricks we can do. Say you have Tesla and it's dropped a little bit, but it's still holding this resistance. It went to 320 instead of 334. So this trade that we were looking at, the 385, 380, that's collecting 150. That's at 434. So if the underlying price is at 320 instead of 420 instead of 434, this spread right here will be making more money, but the probability of profit will be less in their probability of profit. So you could do one of two things depending on how aggressive you want to go. You could drop your strikes down and collect the same amount, and that's a safer option. You're giving yourself even more probability of profit because you know that there's a strong support right around 400. Say it dropped to 420. Now you might be able to get away with doing a 370, 375 or a 3670, 365. Selling this 375, buying the 370, or selling the 370, buying the 365. You might be able to collect the same amount of premium and have a little more probability of profit. Or if you want to get a little aggressive, this is user preference. Kind of just depends on your risk management, how aggressive your personal trading strategy is. You could keep it at the 380, 385. You're probably going to collect maybe an extra $20, $30 of credit. And your probability of profit is going to go down a couple percent. It might be 60% instead of 68% for delta wise. But when it comes down to it, we're still looking at the same support and resistance. We're still looking at the same charts. So I haven't fully decided which one. That's one thing that I'm going to experiment with and see what's better. Is it better to collect this extra credit? Is it more profitable to collect the extra credit and leave your strikes the same? Or is it more profitable to drop your strikes down, you win more often, and collect the same amount of credit? That's one. These are what I'm going to experiment on. These are things you can look at to help out to make the most out of your money. Credit spreads are not quick scalps. You let time work for you. So with a normal naked option, say you were just doing, say you're bullish on Tesla and you're just going to do a long call, a naked long call right here. First and foremost, you're going to have to go super far out of the money to even play this, to even try to get something with Tesla at a 40-day expiration. You're $200-$300 out of the money, almost, yeah, just to have the same cost basis at using that 350 buying power. 360, 680 would be your number. 380 buying power, just right around our 350 level. 700 to 680 would be right where you're doing to use the same buying power. That is $250 roughly. We'll round it. $250 out of the money. This is very hard to make money this way. Probability of profit is 3%. Your theta, look at your theta right here. this is a minus 20. So every day you have this position on, you are losing $20. Spread. You're bullish, put credit spread, just like we were talking about. 380, 385, third of the width of strike, 64% probability of profit, 74% probability of touch, $1 plus $1 theta. This is a plus. So you're gaining money off of holding this contract. Instead of losing $20 every day you hold it, you're making $1.35 every day you hold the contract. And every day you hold the contract, theta moves up. The reason why we cut our contracts at 21 days till expiration is because the theta and gamma ratio intertwine, and the theta moves at a heavier level and the gamma moves at a heavier level up, theta moves at a heavier level down. And so I'll do a little more of a a tutorial on that as well, where I can find a actual a diagram to show it. So that's to show it. That's it. That's the basics of credit spreads. Thank you guys. Let me know if you have any questions. Comment, and any comments, subscribe. Thank you. Have a good day.